Good morning from our world headquarters in New York. I'm Manus Cranney.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Stocks extend their declines after the Nasdaq 100 posted its worst drop of 2023 following disappointing earnings results from Google. Treasury yields steady after a poor demand for 5-year notes push yields higher. Morgan Stanley appoints a new CEO. Ted Pick steps in to succeed James Gorman after a 14-year run at the top. Don't miss our interview with Pick and Gorman, 10:30 a.m. Eastern Time today. And the Israeli army makes a brief raid against Hamas in northern Gaza. President Biden asks Prime Minister Netanyahu to delay a full ground invasion to secure hostage releases. The latest number of hostages held in Gaza is 224, according to the Israeli military. A very good morning. We are on correction watch for the Nasdaq because we're down another 1% this morning. This is a day of reckoning, a 24 hours of reckoning for the equity market as the bear steepeners gripped the market. You've got a toxic combo of underwhelming results with bear steepening, and that gives you this index is possibly down 9.2% at the moment. We are careering towards a 10% correction. Meta came out. It wasn't so much their numbers. It was the rhetoric that blew a hole in sentiment. They are trapped by the volatility of markets. Ed Yardeni says growth will continue to outpace value, and he wants to buy some energy and financials, and IT is ahead. Europe, it's gone. This year's gains are gone. We barely had 2% left on the board yesterday. That was wiped out. So, again, it's ECB today. Volvo missing on their electric vehicle target. You've got Mercedes talking about their margins. If you underwhelm this market, you will be brutalized. Europe is down by 1%. Then it comes to a reality check in London. The banks are under pressure, down 0.8%. Taking the hit on China. Danny, you did the interview, but I got to show you the two-day chart just for the sheer magnitude of that drop, because it is down by over £2 billion worth of equity value was wiped out, Danny, in the space of the opening call. Danny, good morning.
Good morning, Manus. Yeah, we'll talk more about that. I was pushing the CFO to say, is this the bottom? And his answer was, in 2 to 4 years, I'm confident China will look better. That's quite the long and wide time horizon. All right, look, it was not just tech. It did definitely set the tone for yesterday in the earnings season, but it was also this poor auction of 5-year treasuries that hit bonds. 30-year yield moved about 15 basis points on the day. It has eased some of those losses. It's still a bit weaker, though, Manus. And that rate differential, that spike higher in yields, not only is it feeding through into what's happening with tech, it's also put us back above 150 on dollar yen. At one point, we had this crazy 80-pip move all of a sudden, and it dropped below 150. Now it's back up above there. But it is clear how much jitteriness is in this market. We also have dollar dominating over everything, Manus, in this kind of environment. Euro, that's sinking by about 0.25% ahead of an ECB decision day. Getting back to that tech story, though, Manus, because tech had really been held up as the pillar of the thing in this market that could survive all the woes. Going to the CFO of what she said on the call, she said, ultimately, we are very subject to volatility in the macro landscape. Manus, is this the regime shift? Is this when we finally get the time where tech doesn't hold up the overall index anymore, regardless of the environment?
Look, it's a day of reckoning. It's not just a day of reckoning. Maybe it is that growth is finally catching up. We're shifting gears. You see that really aggressive move in the steepeners yesterday, and maybe it's one of those moments of where people throw in and, to use that awful word of capitulate a little bit on tech. But we need to differentiate between growth and the Magnificent Seven, and therein lies the point, Danny, doesn't it?
Yeah, it certainly does. But, I mean, again, Manus, I go back to this thing that the Magnificent Seven, those were supposed to be the things that held up in any environment. It held up in COVID times, and now it's finally earnings, which I should say were not even that bad, are the thing to finally cause them tumbling down.
OK, well, let's just put it in perspective. I thought we'd kick off with the curve. And over the past 4 days, there was the end of Bill and Bill's great adventure. They didn't want to be short bonds anymore, and you saw that drop in the disinversion, I should say. But we're back at it. This is a brutal, again, risk in the bond market. Let's bring it to our guest, Mads Pedersen, founder and CIO at Edge Investment. Mads, you'll get your laurels in a moment. We know you've de-risked the portfolio. But here we are. We're at ground zero of what these markets are dealing with, which is a steepening of the curve. We had an awful 5-year auction last night. It's a tawdry kind of line, but is this the beginning of some kind of a buyer's rebellion in the bond market? Good morning.
Good morning. I definitely don't think it's the beginning of the buyer's rebellion. If things really roll over, you want to do a spill and bill and buy the bonds. So I think it's another round of repricing into the macro uncertainty. And if you look, what should really fall if yields go up? Well, that's the companies with the highest valuation and the longest duration. So it's mathematically consistent, as we have talked about before, that these growth companies take a hit when they then, as Danny says, they underwhelm on their earnings. Yeah, they don't exactly deliver no earnings, but they underwhelm, and then we have a hit. They're still, NASDAQ 100 is still up 30% year to date, so it's not exactly a collapse relative to market strength, but it is a significant correction, and it makes a lot of sense given what central banks have done to the yields.
So maybe not a capitulation on bonds or tech stocks, but is that all this is with tech, Mads? Just a correction, or does this point to a worsening sentiment? Again, as I've said maybe too many times in the past 6 minutes, the thing that has been holding up the market for maybe, I don't know, the past decade?
Well, as I said, it's still the thing which has held up the market this year. It's definitely one of the places where those of us who were lucky enough to make money this year have made money. It just doesn't look so appealing when there's so much volatility in the bonds. I don't know anyone who does not see their bills on the big 7 go up, except, of course, we don't see the chips from NVIDIA, but we see our bills to Apple, our bills to Microsoft, they go up, corporate and private. Is it worth paying 30 times earnings for, or is it worth paying 25 times earnings for? That's the struggle. It's not a question of whether it's worth paying for. Now the market is coming down, but as long as we're seeing an earnings recovery, we're just not seeing the type of earnings we would love to see. And when the price of money goes up, the price of people making money goes down if they make them far out of the future. And that's what these companies do when they have a high multiple.
Well, a little bit of it is just a reconciliation that, perpetuation of earnings in a post-zero interest rate world does not last forever. You've been at the front, so you get your gold star now. You de-risked. You took 100% of equity down to 60, and you shaved back on your growth and your defenses. So well done, you. But the question, yeah, it's okay. Plaudits from me are worth nothing. But what do you do next? As you go towards the end of the year, are you prepared to step in, that awful phrase, buy the dip, or how do you prepare to set up for 2024?
Yeah, so buy the dip is not really our style. We buy for the longer run. So what we do now is we look at, in horror, at all the people who talk about, now things are uncertain, so you need to hold private credit and you need to run a lot of private credit risk and lock up your money for 5 or 7 years. No. We look at the high yield bonds and we think they're interesting, they're short duration. That's where we hold, and we might be buying more. We are, at the moment, the high yield market is not capitulating, and therefore we are not giving up on our equities. We're also, if they hold in the spreads, they have widened a bit, but if the credit side holds, if the central banks calm down, yields calm down, then in the next 3 months, it becomes also time to add to high yield and fixed income portfolios and to add to equities. If ECB...
Mads, if I can jump in here, because one of the arguments that Manus and I have frequently heard about private credit is that nothing is giving you diversification right now. Bonds and stocks are falling together. It's hard to find something that really is okay in this environment, maybe the dollar, and that private credit, whether warranted or not, because your money is locked up, you're not seeing that type of volatility. I know you don't agree with that. So if not credit, what gives you some diversification? Because high yield bonds, I mean, again, very correlated with equities.
Yeah, they are correlated. The only reason private credit doesn't correlate is that people don't update the value of the bonds. So the logic is we're facing potentially a recession. We're facing unprecedented risk. Let's go and give some of these managers who don't have the same typical experience as the high yield managers or the senior loan managers have. I would buy the senior loans or the high yield, yeah, but if you give it to younger managers or to private market companies, and you say, so since there's no visibility, I'm going to give away the money for 3 years, 5 years, 7 years. Well, yes, if you buy private equity, but not if you buy private credit. Because what is most attractive right now is the 2-year. If you look at relative terms, the thing which is more attractive than the last 20 years is the US 2-year bond. Yeah, the US 2-year Treasury is fantastic at the moment compared to the last 20 years.
There you go. That's what I should be doing with the dollars that I'm moving into the country. Right. We've got 1.5 minutes left. I want to know what a calm me down ECB looks like, and what does that shift the gears for you? Does the ECB set the tenor and the tone for you today? How hawkish will they be?
They will be a bit hawkish, and that's wrong. Yeah, they should be dovish. Europe is in recession. Their monetary policy works in a year to 2. The marginal utility of them having hiked to 4% compared to 3.5% is declining because you can't do much about the inflation, which is already in the system. So they should just not talk too much about hiking more. We are already in policy mistake territory. Yeah, it's enough. The more they do of hiking talk, the worse it is.
Okay, well, I'm certainly going to strap in my seatbelt then for today.
He's had enough of everybody, hasn't he? He's had a pop at those. He's had a pop at those bond managers. He's had a pop at the. He's had a pop at the sort of the equity people that buy the dip. You're on form today, Mads. I'll give you that.
Yeah. I'm basically hearing you say, Mads, I have enough friends.
Maybe I don't know if I have enough friends. I'm glad to be back on the program. Thank you very much.
Good to have you.
You're a friend to the program, Mads Pedersen. Thank you so much. That's Pedersen of Human Edge Investment. All right, let's get to some other top stories that are trending on the terminal this morning. Now, in banking news, Nomura is overhauling its China business after losses deepen. Sources say the firm's Shanghai-based joint venture is reassessing its strategy. The head of Nomura's China committee says it's great timing to review the business.
And we have a deal. United Auto Workers scores a tentative labour agreement with Ford to end the strike. In the deal, Ford agrees a record 25% hourly wage hike. Pressure now grows on GM and Stellantis as the two car makers are set to meet the UAW today. Danny.
And police in the state of Maine are pursuing a suspect in a mass shooting after a pair of incidents has left at least 16 people dead in the city of Lewiston. Police say they are seeking 40-year-old Robert Card as a person of interest.
Coming up on the show, we'll continue the conversation about the ECB. We'll get a preview with the Allianz Chief Economists, Ludovic Subran and Morgan Stanley. Finally, a changing of the guard. A new CEO will dive into the bank's choice for the top role right here on Bloomberg. It's Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger in London. The succession race for Morgan Stanley, it's over. Ted Pick has been announced as the new CEO to succeed James Gorman after 14 years at the top. Who better to put the context around it than Shonali Basak? She's been tracking this story. Here we go. We know who it is. Is he a kingmaker? Is he a deal maker? Who is Mr. Pick?
He was the man that was known to really start to turn around that institutional securities business, make the tough decisions over the fixed income unit. And now you have a person who has made Morgan Stanley really the #1 at equities trading as well, stepping into the spot with Dan Simkowitz, who is the head of the asset manager, coming in now to run institutional securities, and Andy Saperstein really taking over asset and wealth, which Dan used to run. So you have the new guard over at Morgan Stanley. I've got to say, Ted Pick has been rumored to be the next CEO in training here. He's been groomed for the better part of a decade. And so if it wasn't him at this point, it would have been a large surprise. But it really did come down to the wire here, Manus, in one of the hottest succession races we've seen on Wall Street in a long time.
Shonali, what is he inheriting? And to be more specific, what are some of the highest hurdles that he's going to face?
Well, there are a few things. I had mentioned the equities trading, for example, here, and Goldman Sachs is really picking at that business here. It is intensely competitive, Danny. And we are looking at a moment here where Goldman has surpassed them in a couple of quarters when we look at equities trading in particular. The M&A market has been a softer market, but Goldman and JP Morgan have been surpassing Morgan Stanley of late. And same goes for IPOs. And Morgan Stanley has been traditionally strong in capital markets around the world, but of course it's a very challenging economic environment. And by the way, that asset and wealth manager has been the ballast to those volatile trading numbers, and asset and wealth in particular, missed estimates in the most recent quarter. And so it's a challenging time to take over Morgan Stanley because wealth tends to decline in a tough market. Will it face those secular declines if the market were to turn?
Yeah, the rich just stopped spending a little bit. We've seen that on the champagne at Louis Vuitton. Side curve. Do you think Colm Kelleher sort of is? Do you think he's sort of sitting back going, should have hung around? I could have been the top dog. But he didn't want to hang around. That was the issue.
Well, that, and remember, over at UBS, if you're the chair of UBS, it's kind of more powerful than the CEO in a lot of ways, isn't it? It's different in European.
It depends
banking.
how you craft. It depends really how you craft the role.
Yeah, absolutely. And he's leading one of the largest mergers of all time. Watching him compete with his former shop is a serious moment to watch UBS.
It's spicy.
It's very spicy.
No, it is interesting because, I mean, as you've been saying, I mean, wealth management, bread and butter of Morgan Stanley, and it's something UBS wants to beef up in the U.S. too. Now, speaking of other European bank earnings, Shonali, I spoke with the Standard Chartered CFO, Andy Halford, earlier. Just take a listen to that.
One particular sector, the commercial real estate sector, has clearly been problematic, not just for us, but for everybody. We've taken some charges in that regard. But overall, the outlook, we still think, over the next 2 or 3 or 4 years, is still very strong in the China region.
And Shonali, Standard Chartered just getting slammed in today's session. I know the European banks, they're very different business models, exposure to China, et cetera. But what have been some of your takeaways from what we've seen so far? Well,
there's a few things. It's weaknesses over in Europe that are coming through the banking system as well as in China. And if you take a look at BNP, it's that miss on net interest income. And if you look at Standard Chartered, it's the charges that they're taking not only to real estate. If it was real estate alone, Danny, that's one thing. Remember, the big U.S. banks have also taken impairment charges tied to real estate in the United States. But when you look at the broader charges, you have a separate charge here tied to Standard Chartered that is separate from real estate alone, tied to the banking system, $700 million. And so that extra charge on top of the real estate charges and just general weaknesses in lending are something to keep watching on when the bottom will turn out.
Okay, Shonali, thank you. We look forward to your double dip interview today. Don't miss it. Stay tuned to Bloomberg. Shonali will sit down with the outgoing James Gorman and the incoming Ted Pick. That is live from Morgan Stanley headquarters a little bit later on, right here in New York. Don't miss it. It's appointment viewing at 10:30 a.m. Let's just show you what is going on with those European banks. £2 billion was wiped off Standard Chartered's value at the open of trade, down 18%. It closed back 8% at the moment. You look at Swedbank off 8.5% and Paribas down 4% as bond trading slides in the French fixed income division at Paribas, right here on Bloomberg.
President Biden and Israeli Prime Minister Benjamin Netanyahu have discussed efforts to secure the release of hostages and boost aid deliveries to Gaza. Joining us now is Bloomberg's Paul Wallace. Paul, one of the messages from Biden has been very clear. That is, delay a ground invasion until Israel can successfully get the release of more hostages. Where are we on that, on the likelihood and potential timeline for a ground invasion?
Hi, Danny. Yes, those comments from President Biden were pretty interesting. While we and others had already reported that there was pressure on Israel to delay this ground incursion of Gaza, that's not what the U.S. was saying publicly until of course, Joe Biden spoke yesterday. So the hostages are a big concern, and as far as we can tell, that's the major concern for Israel's major allies. They want to see a bigger push to get those roughly 220 people released by Hamas and the other militant groups that are holding them. And I think, broadly speaking, Israel has accepted that. It's very much still saying that a ground offensive is going to come. It's not saying when, but I think it is happy to allow for space for hostage negotiations to continue and hopefully get as many people out of the Gaza Strip as possible.
Okay, Paul, we will leave it there. Obviously, the narrative has shifted from both Biden and from Macron warning about the risk of a full-scale invasion. Just briefly, the humanitarian situation on the ground, Paul. Just give us a very brief update.
The situation in Gaza does seem to worsen by day. The UN and other relief agencies that operate there are sending constant warnings about just how bad it is when they look at the fuel situation, the food situation, the water situation. Aid is still going into Gaza, but in very small quantities. It is trickling in, and the US and others, Egypt, are pushing for more to go in.
Paul, thank you very much. That is Paul Wallace. Now, coming up, we're going to return to the conversation of the ECB decision. Ludovic Subran, Chief Economist at Allianz, joins Manis and me next on Bloomberg.
Welcome back to Bloomberg Brief. I'm Manis Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stocks extend declines after the NASDAQ 100 posts its worst drop of the year, following disappointing earnings from Google. Treasury yields steady after poor demand for 5-year notes pushed them higher yesterday. Morgan Stanley appoints a new CEO. Ted Pick steps in to succeed James Gorman after a 14-year run at the firm. Don't miss our interview with Pick and Gorman at 10:30 a.m. Eastern Time. And the Israeli army makes a brief raid against Hamas in northern Gaza. President Biden and Prime Minister Netanyahu are said to delay a full ground invasion to secure hostage releases. That's the request from Biden. The latest number of hostages held in Gaza is at 224, according to the Israeli military. Now let's get you into your markets this morning, because it has been a tough 24 hours for markets, but that is starting to ease. We do have yields basically flat at the moment. Manis, that was not the case yesterday. We had a challenging auction, shall we say, for the 5-year yield. There wasn't tons of demand. It was weak, and so we had a 15, 16 basis point move higher on the 30-year yield. Again, we're more calm this morning. We've had a little bit more ease in yen. We are still above 150, but we've had a lot of volatility in this thing today. Again, those jitters of intervention risk are alive. They are present. We are still looking at a euro, which is much weaker today. We're on the eve, not the eve. We are hours away from an ECB decision. But, Manis, given some of the calmness we are seeing in the cross-asset picture, it does feel like the tone is being set by tech. It's being sent by earnings, which shareholders have not received too warmly.
And if you think of that tech story, Danny, the Magnificent Seven, it's almost like a massive boat that's taking on water from some big punches in the bow, from Alphabet down over 10%. Meta, not so much the numbers, but about the outlook and being trapped really by the rhetoric or the guidance on the macro landscape. We are on correction watch in the NASDAQ. We just caught up with Mads Pedersen there, who said, look, this is not a dramatic implosion. It's just a reappraisal of risk relative to where the bond yields are. But it is the Magnificent Seven that are taking on water and under pressure. So it's also chips under pressure as well. Banks, autos, all of these sectors are causing pressure. You had a gain still on the board for Europe at the start of business yesterday. That is gone. You're looking at the autos under pressure, Mercedes and Volvo. Volvo will come up at the bottom of your screen. They missed on their electric vehicle target, and to that end, the market, the worst performing stock in Europe at the open was Volvo. Then it came to the calamity of the banks within the United Kingdom. You had Standard Chartered really taking some pretty significant charges. It's not about the actual charges, a total of $886 million of a hit. The stock dropped by the most since 2012. It has recovered. It was down 18% at one juncture. So there is this broad-based lampooning of anybody who disappoints in any way on the guidance in earnings. As we go into the end of the year, you need a substantial reason to take on significant risk at this juncture. Danny.
Yeah, Manus, and I mean, the data has shown, even for companies that surprise the upside, it's not too well received. Speaking of not well receiving, can I just say I loved Mads this morning, making no friends. He was like, okay, the ECB, if they're hawkish, policy mistake, and also private credit.
Oh.
I don't want to give my money and lock it up with those young people out there.
Yeah, but you love private credit. That's all I got to say. You're all over this private credit thing. I'm much more of a bond sort of, meat-eating bond trader rather than a quiche-eating commodity trader and a private equity trader. Go on.
A quiche eating. I just want to be clear. I myself don't invest in private credit. I just enjoy interviewing the folks over there. So let me just make clear my journalistic integrity is intact. All right, Manus, let's talk more about the ECB. It's set to keep interest rates on hold for the first time in more than a year, following 10 back-to-back increases. Let's get out to Athens, where this decision is taking place. Bloomberg's Maria Tadeo is standing by. Maria, the market's expecting them to hold. So where could the fireworks potentially be?
Yes, Danny. And by the way, we're in Athens. There's a reason for this. As you know, every year the European Central Bank takes one meeting away from Frankfurt. They rotate among the members of the euro area. So that's why we're here in Athens. Now, in terms of the positioning going into this meeting, as you say, for the market is almost fully priced in. The European Central Bank will hold. That means, of course, they keep the rates unchanged. And that should put, in theory, an end to this very aggressive hiking cycle that we've seen from the European Central Bank. You've had 10 consecutive hikes, more than 450 basis points now of tighter policy. Of course, this is a decision that does not come in isolation. You also need to see some of the elements that we got this week. We talked about the PMIs. Again, an economy that cannot catch a breather. We had the lending survey. And of course, the geopolitics. This is a central bank that cannot escape the geopolitics. Already, the head of the ECB making comments about the situation between Israel and Hamas, some of the ramifications that it could have, especially in energy. And that is assuming that there isn't an escalation. Now, you put all of this together, as I said, for the market, there is now a very strong case, of course, that the ECB holds today. The question is, when they hold, if they do, and nothing is official until she makes it official, is the tone that will accompany that decision.
It's interesting. Maria, good to see you. What is it that I always got to stand outside a wet, mizzling, dreary Frankfurt headquarters, and you get the glamour of Athens? There's something in that. Lagarde did speak yesterday, and it was quite interesting. She spoke on TV. She made some comments, in a blackout period, in a closed period. But if we look at the press conference, how finely balanced is the rhetoric for her today? She's really got a hard line to tread, hasn't she?
Yes, and Manus, that's an excellent question. And in fact, just to give you maybe some insight as to that TV interview yesterday that she gave with a Greek network, what I'm being told is that this was an interview that was pre-recorded. As you say, this is the blackout period, so the time was perhaps strange, but I'm being told that this was a broad interview that mostly focused on the Greek economy. She talked inflation in general and did not signal a policy stance going into this meeting. So she did not want to send a signal with those comments. Now, in terms of the press conference, yes, the tone matters. If they hold, will she say this is still a situation that they have to assess? Will she now be willing to say we are at peak, this is it, basically the end of it? Remember, for a long time, she's not willing to put a number on the peak rate. And then, of course, matters. There's another question on the balance sheet. Remember, there's a lot of perhaps speculation that the ECB may be willing to tweak the end of the PEP reinvestment. It lasts until the end of 2024. Are they willing to make changes? So that will matter, too.
Can I just say, Manus, you lived like literally on a beach for many years. You get no sympathy for me for not going to Athens.
I just want sympathy from anybody that I can get it from. That's just that's the general strategy that I apply. But I know Maria's not long on sympathy for anybody.
Well, you know what, Manus, it is 5:30 there a.m., so you get my sympathy. Hey, Maria. Thank you very much for joining. We know you got to prep for this decision. Bloomberg's Maria Tadeo there. All right, let's bring in now our guest on this. It's Ludovic Subran, the chief economist over at Allianz. Ludo, I don't know where you are in the world right now. Hopefully somewhere warm and beachy, unlike Manus and me. But tell me, okay, this decision in Athens, we're just catching up with Mads Pedersen in the past hour, who says even hawkish language from them would be a policy mistake. Is he right?
Come on, we have the worst PMIs ever. We have these conflicts in the Middle East. I think Matt is just, hardcore German by now. So he's into these very hawkish moves. I can where it comes from, because everybody is worried that the ECB throws the baby with the bathwater a bit too early, given what the Fed could do. But look, 4% is huge. I think the recession in Germany and Poland are very worrying for the zone. We see pass-through in the housing market that are very concerning. We see the sell-off on Italian BTPs that is unheard of, and that is not going to get better with the fiscal credibility this government has chosen to exhibit. And then we see also this refinancing wall for companies in 24. So I think, it's enough. And tail tightening will do the job. So I guess the pause is warranted. My main concern now is what's going to happen on QT, on quantitative tightening, because I think what's happening on the Italian spread is worrying, and we need to make sure we have some dry powder should something happen. And the TPI, the transmission policy mechanism, may not be enough, but flexible, PEP may actually be the key. So let's hold to that, bullet as long as we can.
So let's just take, you've thrown a lot at us there, Ludovic. Of course, I'm a little bit more, I'm battle-scarred from BTP Bund spreads, having lived through the debt crisis, Danny and I having reported on it. How significant is it? They have a heck of a debt load. They've boosted their fiscal target. The spread is 200 basis points, up 45 basis points from the low. How significant is that? Or has something shifted? Are we going to have a different kind of fiscal crisis in 2024?
It's the risk. To be fair, I'm very concerned about the fiscal trajectory that the Italian government has chosen. I'm also a bit concerned about the fiscal trajectory my government, the French government, has chosen, where we see that the ultimate goal is really to be below 5% deficit. That's a very weak goal, So yes, the risk is there, but there is so much fiscal discipline already happening. Real rates are positive or are coming into positive territory very soon. The debt servicing in most countries has doubled, if not tripled. So I would say, look, there is enough to be fiscally disciplined. Yes, there is a risk that things go a bit in the wrong direction, but having more than a point or a point and a half of shaven off from the ECB2 growth is the most this euro area can swallow, as we see the regional energy crisis not going anywhere, and we see a bit of suffocating on the consumption side. And the consumer is really, very affected by negative wealth effects. So I think more may not do as much good in tightening whatever the supply side can do, and it's happening. Disinflation is happening. So let's not do a policy mistake. Yeah.
All of this makes me think, Ludo. We talk all the time about what kind of landing it's going to look like, but what does it look like after we land? This doesn't look like a European economy that even once inflation is tamed, even when the ECB is done, that can get off the ground again.
I think here in Europe, everybody's eyes are on Trump coming back in the U.S. because if he does the playbook 17-19, then we're going to have a big, a boost of growth in the U.S. and then maybe a dry up of dollar liquidity elsewhere, and Europe will still be struggling. Remember, we have elections that are very important where, extreme parties could be on the rise. So, yes, there is a major risk of repeat of 2012. That's the background. The good news, I would say, is that we've done giant leaps over the past years on the back of crises. So I hope that we can continue to do some additional, calibration of what needs to be done, especially on closing this discussion on the fiscal rules, because now that's why there is, this stray, moves, because there is no binding of what we want to expect. I also hope we make some significant, moves on strategic autonomy. And on what positioning we want to towards China. I also hope we make strategic moves on competitiveness, and whatever has happened on the energy market is important, but it's not enough, right? So you're right. The main problem with Europe is either we go back to the old playbook and then we're stuck because the others have moved on, or we try to have some form of additional layers of strategic autonomy and statecraft. Makes us a bit less vulnerable. But this is a political, Ludo, move that's not easy.
Yeah, unfortunately, we have to wrap it up there. We're out of time. Let me just say you're full of surprises. I did not expect Trump to be the answer to a question about European growth. Interesting stuff. Ludovic Subran there of Allianz. Thanks so much. This is Bloomberg.
so grateful and so humbled to have gotten a unanimous vote on the floor by all of my colleagues here. We went through a lot to get here, but we are ready to govern, and that will begin right away.
There's a word you don't hear often, unity. The new Speaker of the House, Mike Johnson. Let's get to Jonathan Tamari. He's our Bloomberg government reporter. So, how did he unite the House GOP after 3 weeks of conflict? It really is, it's a significant deliverance, isn't it?
It certainly is, and an unexpected one. He's a person who's not well known even to other members of Congress, senators. Don't really know a lot about the guy. You know, Chuck Schumer, the leader of the Senate, says he's never met him. So they're going to be working together very closely now. And I think he benefited in a lot of ways from being such a low-profile person. Unlike the previous nominees for Speaker in the Republican Party, he had not had built up any kind of personal baggage or enemies within the conference. So he was conservative enough. He's very conservative on policies, conservative enough to kind of please the right wing that set off this entire saga. But he's also kind of got this folksy manner that I think makes him acceptable to more moderate people, where he's not a combative kind of in-your-face presence. And so basically nobody hated him. They all found him acceptable, and they all wanted this over with. He got total support after these 3 weeks to become the next Speaker from Republicans.
You know, it's funny because I was talking to someone here in Europe about putting together European Bloomberg programming, basically saying, okay, you know, the European audience won't know who he is. And the retort back to me was, neither will an American audience know who he is. Who is he? What's his background? What are some of the key policy areas he's focused on?
Yeah, and there's a big race on because he's so unknown. There's a big race on to define him. He's an attorney. He's from Louisiana. He served very briefly in the state legislature in Louisiana. He's only in his 4th term in Congress, so pretty new still, especially to become Speaker. He's very socially conservative. He's a very religious person, has had some very strong anti-abortion views, very strong views against same-sex marriage, against teaching of LGBTQ issues in schools. And so those are some of the primary things that he took, his primary policy areas that he might be known for. He was also a key figure in trying to overturn the 2020 election. He encouraged Republicans to sign on to a lawsuit trying to throw out the results in a number of key states that President Biden won. And then he kind of gave them a lot of the rationale that they used on January 6, 2021, when they objected to the election results on the House floor. And so those are some of the major things that he's been known for, and that Democrats are trying to stick to him.
Hey, Jonathan, thank you so much for waking up early for us. I'd like to say this is the last time you'll have to do it, but you and I both know there's plenty more drama on its way. Jonathan Tamari of Bloomberg Government. All right, let's turn from big government to big tech. Earnings season continues. Meta dashing hopes of a long-term recovery. Amazon is on deck after the bell. Joining us now is Matt Bloxham of Bloomberg Intelligence, who's also been up early. We've been up early discussing this together for some time now, because it kind of feels like the story, the tone setter of the day. What kind of tone has tech earnings set?
Confusing, I think, is probably a good way. I mean, it's been a real kind of roller coaster ride the last couple of days, and I think Meta itself was a roller coaster. It was fascinating watching last night the print come through. Generally, the initial take seemed to be quite positive, and then you had that surprise comment in the earnings call that, you know, they were uncertain about the outlook for revenue in 2024, and suddenly the mood changed. And I think when you combine that with the amount of money they continue to spend on the metaverse project, billions of dollars a quarter, that combination of high spending without any obvious near-term return, and potentially their core advertising business, which would make all their money, potentially going to face tougher times in 2024, suddenly became a kind of a less palatable mix for investors.
Right.
Yeah, and it was that line from the CFO, very subject to volatility in the macro landscape, despite the top line number. I mean, we've got a lovely story out at the moment. $200 billion worth has been erased from big tech so far in this earnings season. That's Alphabet and Tesla. How does the picture for Meta, let's say, compare to the other firms that rely heavily on advertising? Because we don't seem to have spent a great deal of time talking about advertising. We seem to have spent a lot of time talking about the outlook and the projection, which is maybe more important.
Yeah, absolutely. And yeah, it's been an interesting contrast because Q3 definitely seen a lot more ad spending by big brands than perhaps people were expecting. But everybody knows that the slowdown is coming. You know, we've had WPP today too, kind of warn on revenue. You know, I think budgets are expected to come down in Q4. And if the current geopolitical and economic uncertainty persists, that's going to extend into 2024. So it's the forward view that really matters. And I think people are bracing themselves for tougher times ahead for anybody that is exposed, as Meta and Alphabet are in a big way to advertising spend.
Honestly, I can just picture in my head the C-suite at Amazon with their terminal pulled up, looking at what tech stocks have done every time after they've reported, and must be dreading today to some degree.
Yeah, well, I mean, also they've got quite a diversified revenue pool. Obviously, most of their profit comes from Amazon Web Services, so I think that's where the focus is going to be tomorrow. Consensus is looking for about 12% year-on-year growth, which would be steady on last quarter. They are the leader in cloud services, and I think they'll have a good message to give there in terms of the tailwind from AI. They have a fledgling advertising business. So they're trying to challenge Google and Meta on that area.
And to be fair, Microsoft did well off the back of that kind of narrative, too.
Yeah, exactly.
Yeah. Matt, I'm afraid we're going to have to leave it there. Matt Bloxham of Bloomberg Intelligence. This is Bloomberg. It's Bloomberg Brief with Danny Berger in London, Manish Cranny in New York. Let's take a look at what's ahead, get you set up for your trading day. And the big event, it will come at 8:15 a.m. Eastern Time. It's the ECB rate decision. That will be followed by President Lagarde's news conference at 8:45 a.m. Then we get a slew of economic data. It's another round of U.S. jobless claims. We have third quarter GDP and durable goods at 8:30 a.m. Then after the closing bell, Manis, we're going to get tech earnings. Amazon and Intel will both report their results. We're just talking to Matt Bloxham saying that Amazon, there is some reason maybe to be cherry around about the cloud business. But, man, investors have just been so bruising this earnings season for tech.
Yeah, well, I mean, it was Microsoft that had the bid on the back of their cloud earnings relative to Alphabet and Google. I'm just looking at the total numbers. $200 billion has been wiped off some of these big tech names. Just looking at it, Alphabet dropped by $180 billion. Tesla down $72 billion after their earnings. And Meta, as you can see, up for a rough ride this morning. And that's to do with the macro outlook, isn't it, Danny?
It is. I mean, saying that, unfortunately, we are subject to macro volatility. And to that point, I mean, there's no one who can humble you like Mads Pedersen from Human Edge. When we said to him, is this capitulation, not just in bonds, but in tech? He said, no, Manis, no, Danny, this is not capitulation in tech. This is a simple resetting. If rates are moving higher, these duration equities are going to be hard hit when you're looking at cash flow further out getting discounted. That's all this simply is.
Can I just say is that's the fund manager who came on the show literally at the start of the summer and said, I've gone from 100% equities to 60%, and I've moved my growth from 50 to 30, and my defensives down as well. So, you know, I mean, he is ahead of the game. The issue is this: we are technically moving towards corrections in the NASDAQ. Yeah. And the S&P 500 down 8.5% from its 2023 high. So these are critical days for both those markets.
Yep. And the question is how goes tech, goes the rest of this market? This is Bloomberg.